Hi everyone, it's Peter Schiff. It's Monday, December 13th, 2010. Well, we had a lot of strength across the board in commodities today. The CRB closed at a new two-year high, I believe, just under 320. Some of the standouts, crude oil was back at $89 a barrel, just under the $90 mark, but it looks like it's going to be above $90 a barrel very soon. Last week I know copper hit a all-time record high. The dollar was weak across the board today, particularly against the euro and the Swiss franc, but it was down against every major currency. The dollar index dropped 1 percentage point. We're at 79.30. Silver was up, I think, 80 cents an ounce, 90 cents an ounce. It was up over $1 at one point during the day. Gold was very strong. Continued to be weak, although the bonds managed to rally back from a sell-off early this morning to put the yield on the 10-year, I believe, at about 3.37 or something like that. It was a 6-month high in the yield on the 10-year. The 30-year bond yields were also rising as well. What is the catalyst for what we're seeing? We're seeing weakness in the dollar, we're seeing strength in commodities prices across the board, and weakness in bonds, meaning rising interest rates. Well, I believe there's two recent catalysts that are driving this momentum. One of them was over the weekend. On Saturday, we got news from news from China that inflation is heating up even faster than other people had believed. The annual increase in consumer prices in China was, I think, 5.1% year over year, just over 6% on a producer price level. Food prices were up about 12%. I think it was 11.7% in a one-year period. Inflation is really running out of control in China. It's going to get worse. There was some fear that China was going to raise rates over the weekend to try to squelch that inflation. They did not do that. And that might have given some more impetus to commodities to rise and the dollar to fall. But the predicament that China is in is that China's inflation is imported from America. They send us their products and we send us our money. They buy up that money by printing up their own currency, and it's that growth in the money supply in China that is the inflation, and it's the reason that prices are rising. Now, if the Chinese had raised interest rates, well, that would have done nothing to stop the underlying inflation. In fact, it would have actually made it worse, and here's why. If the Chinese raise rates, that makes RMB deposits that much more attractive because rates are rising relative to the rates on the dollar. That causes more money to flow into the RMB, and now in order for China to keep their currency from rising, higher interest rates only forces the Chinese central bank to expand the money supply even further to buy up those dollars. That's more inflation, not less. The only way to fight inflation in China is for the Chinese to stop growing their money supply. But they can't do that unless they let their currency rise, which is what they have to do, and it's what I'm convinced they will do. The minute they do that, Chinese inflation will stop and American inflation will run out of control. Because instead of the Chinese sending us their products, they'll keep their products and they'll let us keep our money. And so America's inflation will not be exported to China, but we will have to deal with it on our own. And I think that is what's going on. You're seeing that reflected in the weakness of the dollar, in the strength of commodity prices, as people start to realize that a strengthening RMB is in fact coming. The question is when. Is there going to be an abrupt revaluation, or are they simply going to allow the currency to rise faster? If China wants to put a lid on inflation, the sooner they allow their currency to rise, and the greater the magnitude of that rise, the more success they're going to have. But we have to understand what that means here, because that means much higher consumer prices in the U.S. and much higher interest rates. And that is going to pull the rug out from under whatever stimulus Congress and the President think they're going to get out of this new budget compromise, which brings me to the other catalyst for stronger commodities and a weaker dollar and weaker bonds is the budget compromise. Because, of course, the compromise was we preserve tax cuts, we throw on some more special tax credits and a payroll deduction, and we have more government spending, and we have a much, much bigger deficit. So because the deficit is going to get a lot bigger, the government's going to be selling a lot more bonds. And that's why bond prices are weak, because of the additional supply. And also the fear that we're going to have to monetize that. You know, there are some people that think that the reason interest rates are rising is because the fiscal stimulus is going to work, and so the Fed is not going to have to do as much quantitative easing. Well, the fiscal stimulus can't work because all they're doing is increasing the deficit and to cut taxes, but the drag on the economy from the higher deficits will offset any benefit from lower taxes, so there's no real stimulus. The only thing that's stimulated is the deficits. And because there's going to be more debt, and because countries like China are going to be buying less U.S. Treasuries, not more, because they have to tackle their own inflation problems, what's ultimately going to happen is we're going to have more quantitative easing, right? Despite what Ben Bernanke said on 60 Minutes, he's going to have to print even more money to buy even more Treasuries now that the budget deficit is rising. And that is the reason that bond prices are falling. And we have to really pay attention to what's happening in the bond market. I don't think the media is giving anywhere near enough attention to this story. If you look at these charts, it looks to me like we could see a rise in the 10-year yield up to about 4% very quickly. And the 30-year maybe up to about 5.25%. Now, I don't believe that that level is enough to collapse the markets, but it should get the markets to think about the dangers that we face. Now, once we take out roughly 4% on the 10-year, 5.25% on the 30-year, then we can have a much more meaningful move up in interest rates that might send the 10-year up above 5% and the 30-year north of 6%, maybe to 6.5%. Those would be the highest interest rates in about a decade if we break through those channels. And of course, once we do, then we'll know the bond bull market is finally dead. We can bury it. We can put all the nails in its coffin. And we know that much, much higher interest rates are coming, and coming very, very quickly. And that is when the Fed is finally going to have to make that decision that it has been dreading for so long. Does it do something to stop runaway inflation? Does it do something to rein in these deficits? Ben Bernanke said he can raise interest rates in 15 minutes if he has to. Well, let's see, because he's going to have to. And if he doesn't raise interest rates aggressively, right? And what does that mean, to just raise interest rates? That means shrinking the Fed's balance sheet. That means selling Treasury bonds, selling mortgage-backed securities, selling all the things that it bought when it was bailing everybody out. It has to contract the money supply and let rates rise to stop a free fall in the dollar, to try to stop runaway inflation. So the Fed is going to have a choice of doing that, right, and then allowing a bigger economic collapse than the one they think they prevented in 2008, because the minute the Fed has to start raising rates into the recession, right, then all the banks that they bailed out are going to fail again. And the government's going to have to deal with the fact that it can't pay interest on the national debt, that it can't make payments for Social Security and Medicare, that it can't afford to make good its commitments on the FDIC or the pension guarantee. In other words, the government's going to have to acknowledge that we can't keep our promises. Or the Fed is not going to do what Bernanke said. He's not going to raise interest rates in 15 seconds or 15 hours or 15 years. He's going to buy all the bonds. He's going to print all the money that he needs. And then we're not going to break our promises. We're going to fulfill our promises with a broken currency, and that's when it really hits the fan. That's when we really unleash a much bigger thing than just a defaults or depression. We have runaway inflation, hyperinflation, and I think a lot of this dynamic is going to be coming up. It could very easily come up sometime soon, sometime during the next year, 2011. Maybe we can make it out of 2011. Maybe we can make it into 2012. But this crisis is, in fact, coming. And again, if you remember when I wrote Crash Proof, I said that what would set off the crisis was that the housing bubble would burst, the financial sector would collapse because the lenders were going to lose, that the government was going to try to bail everybody out with stimulus, with cheap money. They were going to try to reflate the bubble. And that was what was going to bring on the real economic crisis, because then we were going to get a collapse of the currency, a run on the dollar, a big spike in interest rates, and it was the government cure that was going to kill us, not the government disease. Anyway, that's it for today. I will be back again soon. Take care.